Hey guys, Dan Wittenkeller here. Today we're going to go over my personal 7-step stock trading plan, strategies designed to consistently double your money. Now this is something I have developed over the last 25 to 30 years. It's my personal plan. I've been asked forever to share it with other people, and I really have never done that. I've kept it a secret to myself. And finally, after more and more questions and more interest in learning on how I do this, I decided to put together a little training program to share it with all of you. Please sit back, take some notes, and feel free to email me with any questions. For those of you who don't know me, my name is Dan Wittenkeller. I'm an entrepreneur and individual investor for over the last 30 years. I'm the founder and CEO of Reap.com, which is a leading provider of financial educational products and services. I've been a financial educator for close to 30 years, predominantly focusing on accumulation strategies. I'm also the founder of several other startup companies and a 501c3 charity. I'm a former stockbroker, advisor, and planner, and I've held several licenses. So that's a little bit about me. Well, let's start out by saying, who is this plan for? This plan is for accumulators, not preservation seekers. And what do I mean by that? If any of you have taken the other courses that I offer, the Building the American Dream courses, you would have already known this. But basically, a quick definition, accumulation means that I do not have all the money that I want, need, or desire. So I'm looking to get more. I'm looking to accumulate. And there's certain distinct strategies that go with accumulation. Preservation is I have all the money that I want, need, or desire. I'm more interested in just keeping what I have. I'm not really interested in getting all that much more. If I got a little bit more, it'd be nice, but that's not my primary objective. It's pretty much just to keep what I have. That's preservation. So this plan is for people who are looking to accumulate. This plan is for people at any income level. It doesn't matter if you're a millionaire looking to accumulate or if you only have a couple $1,000s looking to accumulate. It's almost for any skill level. When I mean any skill level, you're going to need to learn a few things. It's not overwhelming. It's not going to take you 25 or 30 years to learn. I've done all that hard work for you. I'd like people that know me know that I keep things very simple, very methodical, easy to duplicate. That's what I believe in. That's what this plan is. Very duplicatable, very easy to understand and to implement. It's also for any portfolio size. Again, doesn't matter if you're a multimillionaire or if you're just have a couple $1,000s to invest. This can work for any of you. Finally, for those of you that are in a very conservative plan or 401k, whatever you have, this is a great way if you have some fun money that you want to just see how aggressively you can grow it. It's a supplement to any other current plan. Okay, step number 1 in my plan is the rules or the guide that you need to follow. Now, for those, again, who have taken any of the other courses, the Rebuilding the American Dream or How to Build Your American Dream courses that we offer at Reap, you've already are familiar with these strategies. But for those who have not taken the course, let me briefly go through these. My strategy and how I invest is based on, obviously, accumulation strategies. And here are a few of my rules. Buy low, sell high. Again, very few people do it. Sounds common sense. Nobody does it. When you buy low, sell high, the second rule comes into effect, which is make a lot from a lot. By buying low-priced stocks, you can control a much larger base of shares. So when the prices go up, you're making a lot from a lot. Third rule is contrarian. Again, for those who know me, I am a contrarian. I go against the flow. I've learned over the last several decades that the masses are almost always wrong. So if they're going downhill, you better go uphill and vice versa. Finally, the rules that we will follow in this trading plan are very methodical. They could probably be taught to a young child. I keep emotions out of it because emotions are what most people bring into their investing and trading plans, and that's why they lose money, is through their emotions. So we're going to follow accumulation strategies, buy low, sell high, make a lot from a lot, contrarian thinking, a contrarian mindset, and very, very methodical. Okay, so step one again is we established the rules. You need rules. You need a playbook. Step two is the target. What am I actually looking for? Again, we're going from a contrarian point of view. So when we do that, we are looking for low price stocks. Remember, buy low, sell high. Not buy high and cry. Buy low, sell high. So we're looking for low price stocks. I always look for distressed companies with a potential to turn around. So if they were in favor at one time, they went out of favor, I'm looking for them to go back in favor again. And another way to target those are through negative press. If you hear about a company or a stock that's been talked about badly in the press, that's something that you want to open up your ears for. What I open up my ears for, jot down the name of the company and put it off to the side. So low-priced stocks, distressed with turnaround potential, in favor, that's out of favor, with the potential to go back in favor. And then also keep your eyes open and ears open for negative press. So now that I know what my rules are, I know what my target is, now the next thing I need to determine is how do I find my targeted stocks? Where are they at? How am I looking for them? Well, when I started this little quest over 25 years ago, I actually used to go to the library, and they had a huge reference book. I don't know, I think they might have came out every month. I'm thinking around every month. They were huge, maybe 1,000 pages thick, if not more, and it was called Value Line. And inside Value Line, every page had a different publicly traded stock, and it had a whole write-up on what the company did. It had a little, a stock chart, basically a synopsis or summary of each publicly traded company. Well, it took me hours to go through it. And they always had a page in the back that would say, the worst performing stocks of the last 6 months or last 3 months. And I used to jot those down. The only problem with going through Value Line and how I did it, number one, it was time consuming. Number two, the periodicals were not real time. They came out, I was usually, a month or 2 months behind on what was happening. So a lot of times I'd go out and pick these stocks. By the time I got around to doing more research and looking to buy them, they were already up in value. So my list was no good. So thank goodness Google came along and solved that problem. So what I do now, I go to Google, I do a search for worst performing stocks. So just do worst performing stocks, and you're going to get several articles that will come up for worst performing stocks. Now, you don't want to we're in 2017 now. You don't want to get a list from 2014 because obviously that's outdated. So you might want to put in worst performing stocks of the last 6 months, worst performing stocks of 2016. And you get articles, click on them articles, and they're going to have companies on there with their stock symbol. And that's what I do is I start writing down these stock symbols and these company names. That's one way I go. Second way, I go to gurufocus.com, 52-week lows. They have a page that will list out from the worst all the way, down 99% for the year. It's going to show the worst performing stocks of the last 52 weeks. And what I'll do is I start looking at that list and narrowing it down. Finally, any news stories. If I'm watching the news, which I very seldom do, or hear something through periodicals about a company that's not doing too well, my ears kind of perk open, and I'll jot the name of the company down, and I might go and see what their stock symbol is and take a look. Value Line, you guys don't have to worry about that. That's old school. I think they're still available, but unless you want to spend hours and hours and hours sitting in a library going through a huge book that's outdated for the most part, you can go ahead and do that. But I prefer to go to Google search or go to gurufocus.com. That's what I do, and that's where I start finding the stocks that I'm interested in. All right, we're going to kind of blow through the next few slides here, but all I did is I took screenshots of the first one. Here's Google search on this slide we're talking about. So when you put in worst performing stocks, you see what comes up. I click on those, I get the name of the stocks and the stock symbols, I write them down, and that's part of my data gathering. I'm starting to accumulate my list of worst performing stocks because why? I want to buy low, sell high. I'm looking for distressed companies. That's my trading plan. It works extremely well. Now here's one of the other websites that I go to. It's gurufocus.com. And what they have, which is really neat, is the stocks at 52-week lows. Off to the left, you'll see the stock symbol, then the company name, the current price, and these are up-to-date prices, the 52-week high, and then how far off they are for the year, whether they're down 90% for the year, 80% for the year. Again, the only reason I am going here, I am going to gather my list of stocks that I would be interested in buying. I'm looking for depressed stocks that are beaten up, that are 52-week lows, underperforming. Those are keywords that I'm looking for to gather my list. Because number one, why? My rule is buy low, sell high. I'm looking for low price stocks. Now here's my fourth step in my stock selection process. I call it the hunt. I want to narrow down my list. Say I go to googlefocus.com and I get a list of 10 or 15 stocks. I go to do my Google search and I get another list. A lot of these will be duplicates, but you may get some extra stocks that come off of the Google search. I'm writing those down. Now, obviously, I'm not looking to buy 15 or 20 stocks. I need to narrow my list down. So what I do when I tighten my parameters, my personal trading plan, I look for stocks under $5 a share. I don't want anything over $5. And you might say, okay, why is that? Number one, buy low, sell high. Number two, make a lot from a lot. I'm going to get a lot more shares for my investment dollars as the price starts dropping. And I found another thing with a $5 threshold is that a lot of your mutual fund managers will not invest or put money in a company stock if it's under $5, which is kind of cool because it gives individual investors time to, gather up, accumulate their base of shares while prices are really low. And as the stock starts moving up, then your mutual fund managers and all your big money starts coming in, and you'll see a tendency of the stock really starts moving when it gets over 5 because all the big money's starting to come in now. So I look for stocks, on my plan, I look for stocks under $5 for those reasons. The next thing I'll do is I'll go to big charts at marketwatch.com, and I'm going to look at several different charts of those stocks. So let's just say I have a list now of 10 or 15 stock symbols. I'll start putting those in, and I want to look at like a 20-year, 30-year chart, whatever gives me the biggest picture of that company stock. That's what I'm looking to do first. So once I'm looking at that chart, what I want to do is to see how high it was in the past. If a stock high was like $9, the highest the stock's ever been was $9, and now it's at 4 or 5, I'm not extremely thrilled by that because if it did turn around, we're looking at a 100% rate of return, which for most people it's awesome. It takes 100 years to do that in the bank. But for all the work that I'm going through, I'm looking for a company stock that used to be at $60 or $70 or $80 or $100 a share that's now down under 5. Because if that company turns around, if it just goes halfway to where it used to be at an all-time high, look at the tremendous amount of money I can make. And I'm going to show you how I've done that in some of these. So I'm looking for under $5 stocks. I go and I see the biggest view first that I can. I want to see the potential on some of these. Again, I get excited over something that was high, now extremely low. And then one of the last things I'll do is start bringing in just some technical things, and you can learn those, through time. They even have software to do it. You're looking at support and resistant lines and isolated highs and double tops and trading ranges, things of that nature. I might be throwing some jargon out there for you, but this is not rocket science. It's pretty easy to learn. It's just it's a matter of time for you to sit down and learn it. Okay, really briefly here, we're not going to spend a lot of time on this slide, but what you're looking at is a screenshot of big charts. And what I want to point out too is that I took one of the stocks from the gurufocus.com to use as an example going forward. It's TDW. You can see it there in the little search bar. That's Tidewater. You can see right next to it is a drop down. You can get a stock chart from one day all the way to all data. And like I said earlier, we're going to go through it next. We want all data to give us the biggest picture of this stock, where it's been and where we think it's going. So what we have in front of us now is the all data chart. This is as far back as it will go for this particular chart on big charts. And it goes back to 2001. And this is where I start seeing the big picture of this stock. The main thing that I look for is how high was it in the past? And why do I need to know that? Well, if it was at $80 at one time, who says it can't go to $80 again? Based on today where we're at, $1.43, $1.43 to 80 would be a tremendous amount of money. $1.43 to $4 is over 100% rate of return on your money. So just a little turnaround and a bounce back on this chart could create fortunes for people. But when I look at this chart, you see like every time it hits 20, it bounces up. It has a little trading range between $20 and $50 a share. There's where most of your activity is. When I go to the 20-year chart, and I would just call this almost a 20-year chart, that's what I'm looking for, is as this stock, if it turns around, where's it going to, where can it go to over the short term and longer term, where could it possibly go? That's all I'm trying to accomplish when I go to a longer term chart like this. Now you got to remember, we're currently doing this for Tidewater TDW because I chose that out of the list, but I would be doing this for, it could be 5 or 10 stocks or even more. I'd be going through this process. That's what I do. So now we're looking at a 5-year chart. And I'm just saying, okay, I'm really, really interested in TDW. So I want to get a closer view of this stock and see what it's done over the last 5 years. And for the most part, I'm looking at trend lines now, more narrower trading ranges. And it's starting to give me a clearer picture on if I'm going to buy this stock, where would I possibly be buying it at? Does it look like it's going to be turning around soon? So closer picture that you get, you can start identifying entry, exit points, trends. Everything comes in a lot more clearer focus. One of the last things I do here is I want to find out about the company of the stock symbol that I'm looking at. I mean, isn't that strange? The investment world does the exact opposite. They want to know everything about the company first before they purchase the stock. The stock could be at an all-time high. They're getting ready to buy it before it corrects, and they'll end up losing money. I don't care what the name of the company is. I'm looking at, first, the technicals. I'm looking at where it used to be, where it's at today. So that when I do go to, in this case, I went to their website to find out who Tidewater is and what they do. And that's going to help me either move forward with a potential purchase of the stock, or it's going to eliminate it as a potential purchase. So let's see. Right on their website, it says, welcome to Tidewater. Tidewater is the leading provider of larger offshore service vessels to the global energy industry. So right there, it's almost confirming to me that I don't personally believe that Tidewater is going out of business. It's a huge company. They're a leading global provider. They're in the energy sector. It's not like it's a company out there trying to reissue BlackBerries again. So here's where you have to have a little bit of common sense. Find out what the company does, and that will either confirm it as, okay, let's keep moving forward with either a purchase of this stock, or we're going to eliminate it off our list. Step 5 includes picking the stock. So now I'm coming down to making a final decision on that entire list that I started with, how I narrowed it down, and now deciding, are any of those stocks ready to be purchased based on my stock trading plan. I looked at the fundamentals to confirm it. In our case, I don't personally think Tidewater is going out of business. I could be wrong, but as we move along here, I'll show you how I protect my risk in case something like that happens if I'm going to purchase that stock. So I'm looking at the fundamentals. They're a leading provider, global energy, sounds great. For whatever reason, I do not know why they're beaten down, or why the stock's being battered from 80 down to where it's at currently today, like $1.50. Is there a good chance it could turn around? Quite possibly, but we'll get farther into that as we move along. What is their product or service? We already covered that. Again, it's not like they're trying to bring Beanie Babies back into the marketplace, or they're sitting on tens of millions of BlackBerries from the mid 2000s that they're looking to try to sell in the marketplace. Totally different. Here's where you kind of got to look to see what the company does. It's just I call it common sense analysis. It does not take a rocket scientist to do this. But the financial world for the average investor is totally upside down. It's extremely upside down. They're doing everything wrong. That's why most people lose money when they invest. It's because the whole plan's screwed up. The whole trading world is crazy. It's built for the guys who are in there to, make money by investing millions of dollars in there, and they do it, 24 hours a day. That's what they do. But for the average person who has a career or another job, you can't follow their plan. It's not right for the average person. You can't accumulate wealth that way. Finally, the last little step in this step 5 is the market acceptance of the product. Does it look like it's a viable product or service that they offer? Common sense thinking, is that something that I believe the marketplace would accept? So that goes through step 5, even narrowing it down more to my potential stock purchase choices. Okay, one of the last things I am going to do before I consider purchasing the stock is I'm going to go to big charts, and I'm going to probably look at a 1-year chart, which is going to even bring the zoom even closer to this chart. And the only reason that I'm doing this, it's going to give me some entry points, meaning where am I going to buy the stock at what price, and it's also giving me some good ideas on where to put a sell stop in to protect my investment in case I'm wrong and the stock doesn't go up but actually goes down. Then I know what my risk is, and I know I'm getting out with a very small loss. I'm going to limit my loss. So I go to a 1-year chart, and the main point for that is to start narrowing down your entry and exit points and your sell stop points. Well, the day's finally arrived. Step 6, the day that I'm going to actually purchase one of these stocks, or maybe a couple of them. I know by looking at my 20-year chart, my 10-year chart, my 1-year chart, going through the company website, that I've determined the stock that I want to buy. I also determine the price that I'd like to buy it at. So I place my order, I put in my sell stops in case I'm wrong, so I'm going to limit my loss. I'm going to go through my money management rules to make sure that I'm only investing what I want to invest into the stock. Look at it this way. Something that used to be at $80 a share is now down to $1.50. I'm literally standing on a step ladder with a mattress underneath me. If I fall, what's the worst case scenario? I'm not falling far. It's a soft landing. I'm protecting my fall with sell stops. Versus a person out there who is looking at a name of a company first, not even realizing what the price of that stock might be, getting ready to purchase a stock possibly at an all-time high. That person is getting ready to fall off of a 100-story building onto a solid concrete floor. That is what the average investor is doing. Through my plan here and what I do, I limit the risk. I literally can teach a 6-year-old this plan. It's just that simple, duplicatable, methodical, common sense. I use sell stops. If I go in and I use example of Tidewater and I buy it at $1.50 and it goes down to $1, I might want to add to my position. I might buy another 1,000 or 2,000 shares. Of course, I still have my sell stops in place. As the market starts turning, let's just say Tidewater starts going up and it's up to $4 or $5 a share. I'm going to move my sell stops up higher. So where they used to be under $1, I might move the sell stop to say $4 if the stock's trading at $5. So if if it's at $5 and it starts going down and gets to $4, it's automatically going to sell some or all of my shares, and I'm going to lock in my profit from $1.50 to $4 when they were sold. And as the stock keeps going up, guess what? I can just keep moving my sell stops up to protect my losses, and more than anything there is to lock in all my profits. So the execution's really simple. Got to remember all these things were thought out ahead of time. And more than anything, it's based on your proper money management rules. This next chart here is pretty cool. I call it the mass casualty entry point because the average investor out there, guess what they're doing? They're getting ready to buy this stock at $800 a share right before it corrects or collapses, and they end up losing a boatload of money. But you got to remember, this mass casualty entry point for the smart investor and for my trading plan, it's our exit point. We're actually selling our shares to these people who are buying it at these record highs. Finally, I've reached step 7, or the exit, and this is where I will go and sell my stock. And I call it closing the cycle. I bought it, now I'm selling it. There's only two reasons that I'm selling it. And believe it or not, it's harder to sell a stock than it is to buy a stock, as crazy as that sounds. Most people obviously sell the stock because they lost money and they're just trying to get out and kill the pain. The only two reasons I'm going to sell a stock is obviously to realize a gain, to lock in profits, or to limit a loss. So if I was wrong and the stock never moved up higher than where I thought it was going from the price at where I bought it at, I'm going to limit my loss and I'm going to get out of the stock and go start my list again. I always said to my clients, and I'll say it to all of you, never be shy to take a profit. Never be shy to take a profit. Again, I'll use Tidewater as an example. Some people might go in and buy Tidewater at $1.50. If it gets to $2.50 or $3, they could be extremely happy with doubling their money and they get out. Other people might want to stay in it and keep raising their sell stops as the market goes up, and they may want to wait till it gets to $50 or $60 a share. It really is a personal preference. It's up to your discretion. But like I said, never be shy to take a profit. Never be shy to make money. The other time that I mentioned you'd get out is if your sell stops got triggered. If the market is you're moving your stops up and keep locking in your profits, which I do. If the market just corrects and I want to just lock in what I've already gained, my sell stops are going to sell all or some of my stock, and I'm out of that position and I'm moving on to the next one. And then all I do is I repeat the process. I start back at step 3, identifying my list, and just keep going on and just keep doing this. What I'm going to show you in a few minutes is how well this process has worked for me. Before I show you how well this trading plan has actually worked for me, you got to remember, guys, there's thousands of trading plans out there. But for the average investor, the person who has a full-time job or full-time business but realizes that they have to get higher than 1 or 2% on their money, and I'm not talking about investing all of your money. Obviously, you're going to have a bank account or some kind of money market mutual fund as an emergency account. You're not going to be 100% fully invested with every dollar that you have. You're going to have bank accounts, but you also have to establish some kind of an investment account where you can start earning higher than 1 or 2% on your money. So yeah, there's thousands of plans out there, but they're all geared towards buying higher price stocks. These are guys that have a lot more money that do this full time. They don't need the stock price to move that much in price for them to make money. They're day trading based on little fractions of movements. Your mutual fund managers that are getting in or out. But for the average smaller investor or the part-time investor that I would call, my strategy is perfect for somebody like that. It doesn't take that long to implement. It's really simple to follow, and you can put it aside and you don't have to babysit it all day long. So how well has this plan or strategies worked for me? I have to put a little disclosure in here, and it says here are a few of my results, which may not be indicative of future results for me or for you. So how well have I done with this? In 2002, I picked Apple at $7 a share. And what it is today, it's up over 1,900%. In 2003, I got Priceline at $1. Based on 2003 to today, it's up 27,400%. In layman's terms, that is 27,400 years of having your money in the bank at 1%. In 2009, I picked up Sirius at 5 cents a share. Currently up 5,900%. 5,900%. One question you may ask, how did you pick these? I just picked them based on the strategy I just showed you over the last 30 minutes. It's exactly what I did to get these stocks. But my primary reason was the common sense one. And I said to myself, do I really think these companies are going to go out of business, or do I think they have a chance of turning around? At the time in 2002, a lot of you probably never, you weren't in the market, so you don't remember. People were predicting, and the experts were predicting Apple when the price started dropping, that they weren't going to survive. They were going to go out of business. This is before the iPod and iTunes and all that. They just didn't think they were going to make it. Same with Priceline. Most people wrote Priceline off and didn't give it a shot of making it. I saw things differently. I saw the potential. I saw what the market was. It didn't make sense to me. I didn't believe what they were saying out there, and the stocks were so depressed that it was stupid not to get involved with it. Same with Sirius. I knew Sirius XM radio was right on the beginning of satellite radio, and I said there's no way that they're going out of business. And that was at 5 cents a share. Now they're almost $4 a share, or if not higher. These are just some of the winning strategies. I mean, I have also other gains, maybe not as high as these, but these are some of the real big ones. And you can see right there, this is a lifetime for most investors. And this has happened over the last, 10, 15 years. So yeah, this plan that I developed works extremely well. It's geared for the average investor, even though the experienced investor can use it. But it's geared basically for the average guy out there to make a lot of money in his spare or part-time. What I like to do now is go over a quick review on what we've covered so far. Again, this is a trading plan that I have developed. I personally developed over the last 20 to 25 years. I've used it for unbelievable rates of return on my money. And it's extremely simple. It's 7 steps, easy to follow, can probably teach, like I said, young kids on how to do this. You have to establish your rules on how you want to invest. Determine the targets based on your rules. So what are you looking for to invest in? Then you got to find a way to find your targets. Once you have found them, you have to narrow them down, make a choice, and then eventually go with that choice. And then in the end, you sell at a profit or you limit your loss. It's plain and simple, pretty easy, methodical, non-emotional. It works tremendously well. So what's next for you? Well, we'll go through a couple of things here. If you do not already have a stock account, open a stock account up. Again, if you heard my other programs, I always would suggest a discount brokerage firm just like E-Trade, Scottrade, TD Ameritrade, Charles Schwab, Fidelity. If you already have a stock fund or a stock account open, that's great. Second thing, go through all the steps. Start at step 3. Start finding stocks for you to invest in. Proceed through the steps 4 through 7. Go through them methodically like I did, like I just showed you. And then repeat the steps as often as possible based on your personal plan. You got to remember, proper money management is everything. I cannot stress that enough. We are not all geniuses. We can't really all predict the future. We just take the tools that we can learn and put them to work for ourselves and to protect ourselves, and minimize risk. That's all we can do. And proper money management is fundamental to that. You don't throw all your eggs in one basket right away. Diversification is not the answer either, because you just kind of minimize, the punch or the effect that you can have on growing money. Finally, another thing you can do is join the REAP Green membership. It's a new program I started at REAP. I think it's only $10 a month, somewhere around there, and you get unlimited access to private groups. You get access to me answering your questions, going over stock charts, things of that nature. It's ridiculous, $10 a month. It's crazy cheap. But that's what I would say is next for you. Take these steps, start applying them to your own plan. Take time with them. You don't have to learn them overnight. Like I said, they're not hard. They're not rocket science. It's actually pretty easy. They're easy to duplicate, easy to implement. Just get comfortable with them and start making money. I mean, there's a tremendous amount of money to be made out there. Go ahead and get your share of it. Finally, I want to say a big thank you to all of you. I really appreciate you, studying my program. It's basically studying my life for the last 25 years and what I've done. Spent countless hours putting this together and learning from it. And I just hope that you take this information seriously and apply it to your own life and your own finances in order just to improve your life and better your life. I know you hear the old saying that money doesn't buy happiness, and that's true, but I can assure you poverty does not buy happiness either. Learn this, retire 20 years earlier than what you plan on retiring, accumulate some money, go out there and open up libraries and contribute to hospitals and do something well with the money and the gifts that you're going to be given. Again, thank you. If there's anything I can do, please feel free to email me. And don't forget, join REAP, join the Green membership for $10 a month. Like I said, it's ridiculous for the information that you're going to have access to. So thanks again, and we'll talk to you soon.